Assalamualaikum warahmatullahi wabarakatuh and very good evening. So today I will present about chapter 6, which is working capital management. Alright, so the first one is what is the working capital management? So working capital management is a require monitoring a company asset and liability to maintain sufficient cash flow to meet it maintains sufficient cash flow to meet in short-term operating costs and short-term debt obligation, which is managing working capital primarily revolve around managing account receivable, account payable, and inventory and cash. So we can see at the slide is the continue oversight of the firm current asset, including financial required for maintaining those assets. Alright, so second one is concern regarding the company management of liquidity as a outcome is a comprise decision making concerning the proper level and mix of current asset as well as the appropriate level and mix of current liability. Alright. So this is function of the working capital management. The goal of working capital management is establish of a risk return trade-off that both the company worth. As a result, current asset must remain accessible at all time to back up the company task, while holding need to be maintained as a minimum to reduce investment as well as the cost of financing. Alright, so working capital divide by 3, which is a relaxing policy, restricted policy, and moderate policy. So in the three of the policy in the working capital management, we want to know the differentiate between relaxing policy, restricted policy, and moderate policy. Alright, so the first one, which is a low risk policy. Alright, second one, restricted policy is a high risk policy. And number 4 is which is a mix of relaxing and restricted policy. Alright. For the relaxing policy, subtain significant amount of current asset with a flexible credit policy. Alright. Which is high liquidity and potential low profitability from the investment due to low probability of current asset relative to fixed asset. This is for the relaxed policy. So we'll continue with the second one, which is a restricted policy. For the risk policy, as I say already, with the higher risk policy, alright, a return low amount of current asset coupled with triggered credit policy. Lower investment is current asset enable firm to invest in fixed asset, which result to high profitability but low liquidity. But the last one is a moderate policy. Moderate policy, which is a mix of relaxed and restricted policy. Moderate risk and return, maintain liquidity, invest in positive asset, and at the same time, hold sufficient current asset. So we can compare to the two term, which is a profitability and liquidity. As we know, liquidity is the higher in the increased current asset. Alright. So for the profitability is lower current asset, and for the increased current asset, probability is higher, and liquidity for the increased current asset which is lower. So we continue in the next part, which is what are the strategy. Alright, for number 1 is the maturity matching approach. Second one is aggressive approach, and the third one is a conservative approach. So as you can see, maturity matching approach, the firm utilize temporary financing to finance immediate current asset as well as permanent financing to fund long-term asset. This strategy generate moderate risk and moderate return. Compared to the aggressive approach, this approach is a riskier since it applies short-term funding to fund some substitute current asset. Long-term financing would be used to fund all fixed asset, but only a portion of the permanent current asset would be utilized. So this method a compass with higher risk and high return. Last one is the conservative approach. For the conservative approach, it is long-term financing serve as the basic for the majority of the company asset. Long-term financing is utilized to sustain fixed permanent current as well as every temporary current asset. So the last one is this approach encompass a low risk and low return. That's all for chapter 7. Thank you.